And then there's a coronavirus taking out the supply chain, which is the greater, Tiger Rim area. There's so many reasons to be bearish that it seems that I'm insane that I disagree with everybody else. But I disagree with everybody else with Bear Stearns, Lehman Brothers, General Growth Properties, etc. European debt crisis, part two, the euro, the failed experiment that nobody wants to admit failed, and on and on and on and on.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, excited to have Reggie Middleton of Veritaseum on the show, who I talked with about 2 years ago when I was first finding out about some of the projects that Veritaseum was doing. Quick disclaimer, I know there are a lot of people who are interested in the details of the legal case. And you can go back and see my comments on that because I certainly feel there was some unfair treatment of what he was doing, although we're going to respect that Reggie has signed a confidentiality agreement and cannot dig into that. So if you're looking for that, there are other places to find that. Yet relevant to today's markets, it's nice to have Reggie on here because he was writing about Bear Stearns before it collapsed, a lot of the things that happened in 2008. And certainly with what's going on today's markets, it's great to catch up with him. So before we get started, hit that subscribe button so you can stay tuned. And with that long intro aside, Reggie, it's great to have you on here. Nice to see you again. And how's everything going with you today?
Working hard. That's about the truest statements could be made. So I'm working hard. I'm trying to be as productive as possible. And going over some of the fundamental and macro calls that I made back in the 2007, 2008, 2009 era. And it brought back memories. I have to admit, I have to congratulate my team, my analytical team that helped put that together, extremely accurate. And B, it, like I was saying, we had a chat before this started, the global macro cycles are roughly about every 10 years. And so the local, at least in New York, business cycles. It's been about 13 years, much longer than usual. And we think that's because we've been banging interest rates real and nominal to zero and negative for some time, which kicked the can down the road a little bit. I don't know if a road as long as the road these guys expect it to be. So we're coming to the end, but this is 2007 right now in 2020. So after going through the Bear report, Lehman Brothers, we made this call on all the major banks, Bear, Lehman, Washington Mutual, Countrywide. We also did Miss Merrill. We did Morgan Stanley, Goldman Sachs. And the story becomes clear. If you take a look at enough numbers, you see a very steady pattern. It's screaming even louder now. It's outrageous, so many things that are going on. And I believe it's unprecedented from what we can see because the attempts to force liquidity and growth at the same time, I think is just guaranteed to do 2008 over again on a leverage basis, so much higher. And again, you hear a lot of the doom and gloomers. I don't believe this is doom and gloom, real balance sheet and analytically driven. You show the numbers. I was just showing, I had the interview, I was just showing how the middle class is mired in stagflation right now in America. So Argentina is going through stagflation, hyperinflation and slow economy, but the middle class has expenses that have inflated materially past the actual median income for the male in the country. And this is very easy to see. Of course, not captured in government CPI numbers, but if you take a look at actual inflated costs, housing, energy, food, clothing, etc., this is the income and those are the expenses.
Yeah, and for folks who, and we'll post the link to the report you wrote on Bear, I guess 12 years ago now already. But for folks who aren't already familiar, what was it in particular that you saw with some of these banks, especially that we may see playing out now? Because I think a lot of people are confused. President Trump, the Federal Reserve, they say, look, the stock market's great, go out, buy stocks and, have a Miller. Yet I think, as you're mentioning, you saw back then and today, beneath the surface, not quite as advertised. So what in particular was it that you saw then and that you're seeing again now?
Well, then it was easy for me to see. I was a real estate investor. I bought real estate. I'm not a short-term guy, so I was buying real estate to build a portfolio to try and give something to the great grandchildren. I started in 2000, back when you had fundamental reasons to actually buy real estate, small income producing properties. And so I had a fundamental drive. I also caught the credit boom, bubble, to be honest, and I caught the housing boom,
Yeah.
then bubble. At about 2006, I said enough is enough. I mean, I did very well from a return perspective, but 2 plus 2 started to equal, like, 1,517. And I tell everybody, I'm not that good at math, but at one point, even I have to figure out there's something wrong there. Sold everything off. And then I said, I should really short everybody who did business because this is a grand slam. Created a team of analysts, most offshore, and found companies who I did business with. And I did a little digging. And what we found was outrageous. There was one company, GGP, General Growth Properties. They, on their SEC reporting, they said they had a 67 LTV, 67% loan to value ratio. Basically, out of all their real estate, they had loans that equaled about 67% of what they borrowed. Relatively conservative, okay? You could get in a decent amount of trouble and still sell the property off and pay your loan back. But I didn't believe them. So their reporting said one thing. I had my analysts go through, I think, about 190 of their properties and revalue each property, got the average leasing rates and expense rates, et cetera, and ran our own calculation. So their numbers said 67% LTV. Our numbers came up to about 170% LTV. Somebody's lying, okay? They filed for bankruptcy a year later, so you could guess who was lying. And that's how I made money. I found opportunities that were way out of the whack. I took a position that would benefit if they went into equilibrium or beyond, which usually happens, and I got paid for it. And I also sold this research, or sometimes gave it away, like in the case of Bear Stears, Lehman Brothers. So when you see where this is the equilibrium, this is the actual value, there's a big bright red sign. That big bright red sign is flashing all over the place now. The mere concept of negative rates should make everybody go berserk. There's no such as negative rate. That's like anti-life. Anti-life is death. So you can't really have a discussion about it. Things such as I explained stagflation. Okay, I call it stagflation. The fact that incomes are now below the cost of living. Okay, and that's without taking into discretionary expenditures, which all human beings partake in if they have a choice. We have the real estate values. Everybody says there's not enough housing. There's not enough housing for the middle income area because everybody's going to the higher end because that's where the profit was. Normally there's a constraint in building the higher end because it's expensive, but nobody cares about expense because you don't have to pay for money because nobody's charging for money because money costs nothing when it's close to zero or zero. You use Asian and European money and it's negative. You're actually penalized for not taking the money.
Yeah.
So that money is forcing itself into risky assets, driving the price of risky assets higher, making them riskier, and it gets higher and riskier, etc. I can go through this to a variety of asset classes. The earnings in the S&P are relatively stagnant. The prices are going up and up and up and up. You take the 5 big tech companies out of the S&P and earnings have stood still. So basically the increase in earnings comes from the 5 big tech companies. Five, that's 1%. Okay, that's where all the earnings growth is coming from. That's ridiculous. And then there's a coronavirus taking out the supply chain, which is the greater, Tiger Rim area. There's so many reasons to be bearish that it seems that I'm insane that I disagree with everybody else. But I disagree with everybody else with Bear Stearns, Lehman Brothers, General Growth Properties, etc. European debt crisis, part 2, the euro, the failed experiment that nobody wants to admit failed, and on and on and on and on.
Well, fortunately, there's a few of us out here that are on the same planet, myself included. I mean, it's incredible watching this bubble continue to get inflated. Although one question on that, where I think you could make obviously a legit fundamental case for how some of these things are in bubble territory. Yet we've seen the Fed, they're not even calling this QE yet, although Powell was out talking about what's going to happen during the next downturn, which I found odd that he's already talking about QE during the next downturn when he says it's great. Do you see something like 2008 happening where things are actually allowed to decline? Or, I mean, we had the market was down a bit yesterday, and I wonder if just they'll keep pumping so much money in that no matter what happens, I mean, it'll be like a stealth bailout. Curious how you see that all playing out with the Fed going nuts like it is.
Well, the Fed is trying to pump up risky assets, but the Fed can't pump up the real economy that way. Right. Risky assets are much easier to manipulate. For instance, you said, the pop has happened. I live in New York, and that was very bearish from real estate. The high-end real estate, condos, 32% correction year on year or 2 years out. That's a lot. 32% is 1/3. So, and if you bought a $20 million condo, you now have a $13 million condo. You took a $7 million loss.
Yep.
God forbid you didn't pay cash. Now you're underwater. So these things are not very well publicized in the media. I guess it's not sexy. Credit card debt, automobile loan debt, student loan debt, massive market. There are a lot of things that are on the way down. When you have contagion, and the contagion caused by the coronavirus scare, and I don't mean viral as in the actual virus contagion, but the fact that where ground zero there is the manufacturing heart of the world. Okay, they're closing borders there. Hong Kong had a 99% drop in visitors. 99%. That's effectively all of it. 18% of Hong Kong's GDP is from tourism. Okay, their greatest trading partner is China, right? China's second largest trading partner is Hong Kong. So both of those are not only not bilateral, everything is shut down. So right now you can take almost 20% of Hong Kong's GDP. You can take at the very minimum 10 to 12% of China's GDP. Okay, that's guaranteed to reverberate. Plus, where are you going to get all your iPhones now?
Yeah.
Foxconn, et cetera. That this is guaranteed to happen. Normally, it would be cyclical, but the normal cyclical boom and bust cycle is being exaggerated every bust and every boom because, in my opinion, they are juicing the booms, right? And then they're trying to throw more liquidity into the bust. To be truthful, they should raise rates during the booms, not after things get too hot.
Yep.
But, I don't know what I'm doing. That's why I'm a crypto guy and do research, and I don't run central banks.
Yeah, well, it never quite is transitory or temporary or whatever buzzword the Fed uses when they tell us it's a one-time measure. Although, again, I think that's why a lot of people, I remember when I first started reading about gold and silver in 2009, felt like the lone wolf. And maybe there's a degree to which that's still the case yet. I think a lot of people see that the Fed is backed into a corner where it's either they let the stock market crash or they print. So on our show, we have a lot of people who are interested in gold and silver. And obviously you're working on some projects that combine gold and silver with the actual means. So that is part one of my interview with Reggie. Really a sharp guy. I've been impressed with him for years. And if you enjoyed that, then you're going to see what's coming next as he talks about the project he's been working on, Veritaseum, and some of the digital gold, silver, platinum, palladium-backed products that they're working on. So just click on that box now and enjoy.